Time to talk about market fundamentals. So Unmesh Sharma from HDFC Securities is joining us now. Unmesh, good morning. Thank you so much for joining in today. Well, we've seen a lot of central bank action that has come by. We saw it with Fed. Now, in China as well, there's an indication that could happen. What are these trends suggesting, and what would this mean for the Indian markets?
So, good morning. So globally what started to happen is that while there seems to be some kind of stimulus on both sides, the reasons are very different. In the case of the Fed, clearly we were at the peak of the cycle. I think that was indicated very well across the commentary from the Fed in the policy documents as well as outside in forums like Jackson Hole. China, on the other hand, is facing a completely different issue, which is that there has been a significant slowdown in the economy and there is balance sheet stress there. So, as we have seen in the past couple of cycles as well, the way in which the Chinese government reacts to that is to pump liquidity into the system and keeps the lending environment very benign, because unlike Fed or India, where the transmission of policy happens through the banking system, there even individual lending at the individual asset level to a large extent is centrally controlled. So, different reasons where I think in the case of Fed, I think they seem to be indicating that the fight against inflation is broadly under control. While in this case, it is a little bit more of pump priming an economy which clearly looks under stress.
Unmesh, good morning. Thank you for joining in. And what does all of this China factor does to a sector like metals, because it has been relying on these measures from China? The stocks are moving higher now that there is expectation that there will be stimulus announced. But do you always prefer metals to be a tactical play, because there will always be some headwind or the other that emerges for a sector like that?
I think, look, the long-term structural trend on metals, and, you would have seen that in all resources, including oil, is the fact that despite having so much turmoil in globally with the two wars, both in the Middle East as well as in Europe, is that metal prices actually haven't spiked so much. And while there are other reasons for this, I think one very large reason has been that China, which has been in the last two large cycles the big sink of all metals demand, if you aggregate it, in a lot of cases like copper or aluminium, they were basically absorbing 50% of global demand. Of course, that's an average. But I'm saying that in general, if the Chinese economy is not doing well globally, metals find it very difficult in that type of environment to go up. And that's true both for oil. Now, all of that is positive for India because we are a net consumer of these commodities as well. But broadly in China, I think what will happen is that we've seen this, in the past, after the slowdown in the global credit crisis as well, is that in the short term, every time there is a stimulus from the Chinese government, there will be a spike in metals. But all of this is tactical. So the way to think about it is that there is a structural kind of bear or underperforming kind of metals basket in which there will be these bear market rallies, which will be timed as per the stimulus in the China, and that's how investors should tactically play this.
Okay, Unmesh, I was going through your note. The projected earnings growth for FY25 is 5.7% and for FY26 is 16.1%.
Yeah.
What is the reason for, what do you think would be the factors that would lead to this low single-digit growth, and what are the factors that would contribute to the growth we'll see in FY25? And what happens in FY26 that we'll see that 16% growth? Is it low base, or there are some fundamental changes that will come by?
Yeah, so look, I think what is happening is that what you're looking at is aggregate. The way in which investors broadly look at earnings growth to a large extent is, X of banks and X of, large resources which are global. So, if you try to bring it down to the earnings growth for the domestic economy, so as to speak, then that number actually is around 12-13%. And, so what happens is that if you X that, that is what you'll see. I think to a large extent, what is happening is that the base effect of the earnings has started to play through. We are a little bit now on what I would call steady state in terms of, real earnings growth of 6-7%, inflation of 4-5%, and then a slight multiplier on that. So while, yes, the headline number is 5 and 16, it's really around broadly around 12%, which you will find each year X of the large swing factors, which is how investors would look at it.
What about this quarter then, Unmesh? It's just a week from now that companies start to report business updates, and then with the IT companies starting to report results as well for the quarter gone by. Is there a particular sector that you would want to watch out for in terms of the earnings performance this time around?
I think, to a large extent, I think if you look at the big sectoral change, if I may, because, I can go on for like on 12 sectors, but I think the one single one which we are keeping an eye on, we really want to know what is happening in the rural economy. I think there is enough, commentary that things have started to improve after reaching a bottom. But I think that with now, by the time the results start to come out, will be the second week, first or second week of October. What we'll start to see is whether this, adequate rainfall in terms of temporal and spatial distribution has been adequate. Because I think to a large extent on the large consumer names where we have incrementally turned positive, this will be a key driver of earnings for the rest of the year. So, come October, I think we'll be listening carefully to these calls to understand whether indeed the rural economy turnaround is playing out or not. And the second big factor would be what happens on the large banks, because that will be a key determinant one on our calls of, a little bit more overweight on large private banks in terms of whether the rate cycle is impacting, how they will impact. And it feels like there is a convergence on the large deposit and credit growth. If that comes out, I think that will be a very interesting play. So large banks has been our call for this. The commentary will suggest whether we should continue to go more overweight. And, it's been a laggard, so whether that is the way forward or not.
All right. Okay, Unmesh, banks, they definitely will be the key to watch out for from here on. That is the sector to watch out. Thank you so much for joining in today with your take on the markets and the outlook going forward as well. We'll slip into a break. Up next,